And now we come to distribution. And here, this is on the ES Mini 5-minute time frame. Distribution is the exact opposite of accumulation. As we know from our basic Wyckofian model, we have accumulation, markup, distribution, markdown, and then back to accumulation. So now we're talking of distribution, which is here. So this is where the strong hands distribute. They offload their inventory in this area. So they've gained all their contracts here. They push it up, which is markup, where they're making money on their trade. Then up here, for whatever reason they see fit, now they want to take profits and also would like to short. So they gain a new inventory. They gain new contracts which they want to hold and sell back down here. And how they do this is they offload all their stock to the weak hands. And this occurs, and this action occurs due to greed, the fear of missing out. As everyone wants in, this propels the market into overdrive and rallies hard. And I'm sure you've heard the examples, and even the taxi driver is talking about stock. And this is when you know the bubble is about to burst. From accumulation here, the markup is where FOMO begins. So as we're driving higher, everyone wants to get on board the action. Then as we rise and push up hard, very fast, we have a market frenzy. Everyone wants to be buying. No one wants to miss out. And this is when the smart money or the large funds, they start to sell. When people are buying, they start to sell. Why? Well, because they can offload a lot of their contracts they made down here, and B, they can reaccumulate to the downside. So they're adding to their starting an inventory to hold for markdown, and then we go back into accumulation. So when markup is occurring and we're rallying very, very high and everyone's jumping on board, the first sign of distribution is climactic action. And this comes in the form of a buying climax, which is the exact opposite of a selling climax. Now, this is a 5-minute time frame. And as we can see, we rallied up pretty hard and we got a huge spike in volume. Okay. Now, ideally, on much higher time frames, we'll have a huge volume and a huge widespread closing off the highs. You can close at the lows or close in the middle. Like previously we have seen for our accumulation, we just reverse the action. So the strong hands are now selling their original stock. And not only are they offloading their positions in this distribution area for a healthy profit, they're also shorting the stock, building an inventory once again. So the process is exactly the same as accumulation, yet reverse. So instead of buying, they are now selling. Now, distribution is harder to recognize in accumulation, yet far more rewarding. The emotion of fear is more powerful than greed. And this is why stocks fall faster than they rally. And I'm sure most of you are aware of this action, and this is the why. You must have noted that we always seem to rally fairly well, and then bang, we fall out of bed very, very hard. We always seem to, our corrections or pullbacks, or if we're in a bear market, is a lot more aggressive in nature. We fall a lot faster and harder than the rallies we do to get there, if that makes sense, rather than the preceding rallies. Importantly, there's something I must say. Around 90% of retail traders will only buy a stock. Therefore, shorting is literally left to the professionals. Why? Well, Due to the rapid gains, the profit, many traders or professional traders will specialize in bearish conditions, taking advantage of the quick sharp moves. And logically, this makes sense. A trader can make more potential profit from shorting 3 or 4 stocks in the same time one stock would have rallied. Their money is working harder, capital is being used more effectively, hence they will only short. But why the retail public only buy, or 90% of retailers only buy, I guess that people feel uncomfortable shorting, or they're not familiar with the process, or no, they can even short. Well, you have to think that a lot of retail traders will, a lot of granddads, for example, might be buying stocks in Apple for their grandsons. They're not aware of shorting. It's for investment purposes. Whereas the professionals, they like to take advantage, and they will specialize in bearish conditions to make large sums of money very quickly. One can use the same thinking with our methodology. However, from a personal viewpoint, I like to be versatile and trade with the ebbs and flows of the market, reading the imbalance of demand and supply as the market unfolds. It's a little like Bruce Lee's philosophical quote, empty your mind, be formless, shapeless like water. Now, you put the water in a cup, it becomes a cup. You put the water into a bottle, it becomes a bottle. Now, water can flow or it can crash. Be water, my friend. So in essence, we will adapt to the market's conditions and read the flow, the imbalance of demand and supply, and can alternate very quickly from being a buyer to a seller and back to a buyer if needs be. I mean, of course, this statement is very contextual. We must take into consideration the trend and lots of other factors. However, the principles remain the same. I tend to trade with the flow of the market. If it's hinting towards a short, I will sell. If the imbalance is demand-based, I look for long plays. I hold no prejudice. There is nothing wrong with using your new skill set found within this logical price action course to only be a seller. In fact, you will become more of a specialist as you're filtering the market in a way. It's up to you. It's up to the individual and what you feel comfortable with. And once you progress as a trader and say you have 200 trades under your belt and they've been well documented, it will be you will know what kind of trader you are, because from your metrics you may find that 78% of your trades may be short based and only 22% are long based, or if you have 60% short trades yet only 30% are winners, and you have 40% long plays and 72% of winners, you know that you should probably be heading towards, or you should be changing your focus towards of being a bullish kind of trader. And everyone has their own metrics, and after you have enough sample size, it'll be very interesting to see and take a look and analyze trades and see what kind of trader you are. Anyhow, back to distribution. Let's quickly go through the principles or elements of distribution. Well, BC is a buying climax, which is the opposite of a selling climax. And we want to see this at the end of a trend. Okay, and we want to see it pop up, ultra wide volume, closing mid bar, off the highs with very high volume, literally falls out of bed. And instead of an automatic rally, we have an automatic reaction. Then for secondary tests, we have an upthrust, which is the opposite of a spring. So this is resistance. We pop up and reverse like this to close weak. And there is a technical term called an upthrust after distribution, which is extremely rare, and I can't recall trading one. And this occurs late in the trading range, and it breaks to the upside convincingly, testing demand before reversing and closing weak back under resistance. It's more of an aggressive, I like to think of it as more of an aggressive upthrust with a larger spread, higher volume that induces a good bull trap, for bullish breakout traders. I'll give you a quick example. So we have an uptrend, bounce around, nice, bang. We get a huge buying climax bar, come down for an automatic reaction, then we rally back up very weak, then we might have an up thrust, then we come down again, so this will be a secondary test. We come back down, break this low, so we know there's selling in the market, then we come back up, test this, come back down, come back, and then towards the end we might go bash, like this, through this, and come and close weak. And this would be an up thrust after distribution. It'll have a very wide spread with very high volume and will induce all this action into bulls who can't read this and think this is a breakout before reversed into close week. So you can think of it as like an upside shakeout in a way. And then from here, price should continue down hard and fast. Okay, so this is called up thrust after distribution. Again, extremely rare, and I haven't traded one. Then we have a sign of weakness. Now, as I previously stated in accumulation, it can be either a successive move with good price action or one bar like we had with the sign of strength. But here, we get a good sign of weakness. All here. This whole move is a sign of weakness. Okay? I thought I would use an example on a very small time frame to illustrate that accumulation and distribution occurs on smaller time frames. They all come in a variety of flavors and the market and price unfolds differently. And this is far from perfect. However, the principles are intact and remain the same. And that's what's important. We want to focus on the behavior of price, because the market is far from kind and will often provide ambiguity. And it's our job as traders to recognize the principles, to recognize the subtleties. And this is distribution on a 5-minute time frame. Let's crack on. Let's go through this. To the buying climax, we can see a drive up and the buying climax bar, huge volume, especially for this time of day. This is a European session in the S&P, and this goes to prove you need to know your market. And obviously this is on the Globex, so it trades 24 hours. But for this kind of volume in the European session is very high, and this would be noted. Okay, we push up, rising too fast, too soon, parabolic. Okay, and then what happens on this bar? We get huge volume, almost double the volume. We close off the highs. The spread doesn't really go yet, so we know there's selling involved. But we don't know this is a buying climax as yet. But the volume is very high and must be noted. Then we drift down, which is our automatic reaction. Nothing to do, we just have to note this. Then ST1, what do we see? Well, there's clear selling. We push up pretty good here with this volume. Then we get a smaller spread, almost, well, less than half the size, with near the same volume. It is smaller volume, however, a spread volume relationship is out of sync. We can see shortening of the thrust. So we know that selling has occurred in this bar. Does this action make sense? Yes. Why? Look to the left. We are in this buying climax area. Although we don't know that's a buying climax, we've noted that supply must be in that bar, and we do get a move from there. So we know that selling must have occurred by now, because selling is occurring again. With a little less selling and a much smaller spread, we know that selling has occurred. However, I still wouldn't note this as a buying climax automatic reaction, a secondary test. If anything, this looks like a weak pullback, but we do make good progress to the downside, and we react for 2 hours. Yeah, and as we react from ST1, we see good selling. There's a good bar with a pop in volume. Now, as we come up to ST2, we can see this is not the strongest rally in the world. However, there are a couple of good buying bars here and here, which is not ideal. But as we get to resistance here at ST2, what do we notice? Well, we're trying to break resistance made from our buying climax. Don't forget, buying climax and selling climax, soon as we react, we always draw resistance from the high because this is a wide spread with high volume. Principles remain exactly the same as accumulation. So what do we notice as we approach resistance? Volume declines and is lower than the original anchor point. And don't forget Wyckoff's statement. It takes equal or greater volume to break a previous area of support or resistance. So what are the odds of this breaking here with this low volume? Very, very low. This is a big tell that the level will hold. And how do we respond from here? Good widespread down bar with a pop in volume. We get good quality selling. And it's here. It's now with this action combined that I'm thinking this is distribution. Because ST2, this secondary test, provides two bouts of negativity. One, we advance to resistance with declining volume. And two, volume is much lower on the attempt to break than the original anchor point. So we're trying to break a previous area of resistance with lower volume. And the cherry on the cake of all this action here is this bar. It confirms, it tells us that we're thinking correctly, and now we want to look for a short play. Okay? So ST3, what do we note? Well, first of all, it's the US Open, volume will naturally be high. But with all this volume on these two bars, we cannot break this resistance. And if we amalgamate these two spreads, we have a spread like this, but if we amalgamate their volume, we have volume that high, that spread, unable to break resistance, made with this volume. So this volume is 1, 2, 3, 4, say 5 times higher. We are unable to break this resistance. Now Wyckoff said it takes equal or greater volume. Now that is greater volume and we cannot break. So something is occurring and that something is selling. It has to be selling, must be selling. And we can see a close off the highs on both of them. Even after this second bar here penetrates, sellers are able to push it back down. And this second bar, there's nothing wrong with thinking we're primed for higher prices. We dip under this bar, reverse to close firm after we test this local level support. So we're thinking we're going to rally, but we have to note all this background conditions, and with all this volume, if we combine them and the spread, we are unable to break. And the close back under is a subtle but powerful tell. And then we react and look how we fall. Look how we fall. Very, very sharp. Spreads increase. Closing all close weak. Volume expanding. Good, healthy selling. Isn't this a fascinating study? It's difficult, but the subtleties are there. The principles of distribution are all over the chart. So in summary, this is to illustrate the principles using a smaller time frame. We don't always get perfect examples or perfect entries. And until ST2 and this bar, we don't know this is distribution until the declining volume on the break followed by the good price action with a pop in volume. However, this is a mild form of distribution. And our skill is to recognize the behavior, the principles. We can note that we rally too fast, too soon, that ends with a huge surge in volume, which is climactic behavior. And then although it's not clear selling, we do sell for 2 solid hours and we make good gains to the downside. As we try to rally, we notice shortening of a thrust and selling emerge in a selling area. As we react, we get a good result, we get some more selling. As we come back to resistance, declining volume, and then a good result with a pop in volume. And then the market opens with these 2 bars, with all this volume. We cannot break this area of resistance. Huge, huge tell. So by combining all these elements and principles together is how we get our story of distribution. Okay? Good. On to the next study.